The banking system is facing a crisis of historic proportions. In just the past few weeks, we've seen the second and third biggest bank collapses in American history, with Silicon Valley Bank and Signature Bank being shut down as depositors race to withdraw their money. And that was followed by the collapse of Credit Suisse, one of the largest bank collapses in European history. Regulators are saying the worst is over. U.S. Treasury Secretary Janet Yellen read out a statement on Friday declaring that the U.S. banking system remains sound and resilient. Minneapolis Federal Reserve President Neil Kashkari came out and said that fundamentally, the banking system is sound. Meanwhile, Citigroup CEO Jane Fraser recently told a conference that the banking system is pretty sound. Funny how all these people at the center of the financial system keep repeating that word, sound. If it were really true, would they need to repeat it day after day? At the end of the day, part of their job is to prevent panic. So it's understandable that they're working to calm bank depositors and investors. But the problem here isn't psychological. It's a numbers problem. It's about rising inflation and rising interest rates. Amid the market chaos, a couple of research studies have come out pointing to the size of the problem, and the reality is, thousands of banks are at risk. In this video, we're going to break down what these studies have discovered and what it means for the global economy. But before we do that, make sure you hit the subscribe button to get instant notifications about our latest videos. In the coming days, we're going to have more news on the financial crisis that you won't want to miss. News you might not find anywhere else. And if you like this video, don't forget to hit the like button. Okay, so let's talk about these studies and what they're telling us about the financial system. The first one of these, from the economists at New York University, came out on March 13th. Just 3 days after Silicon Valley Bank collapsed. What they found was that as of the end of last year, U.S. banks had $1.7 trillion of unrealized losses on their books. To give you an idea of how large these losses are, U.S. banks, in total, have $2.1 trillion in assets on their books. These losses are equal to nearly 85% of the bank's assets. And what does it mean that these losses are unrealized? It means that their accountants haven't included these losses on their books. Why? Because they don't have to. These losses are in the form of debt owed to these banks, and as long as the banks don't try to sell that debt, they don't have to declare what happened to its actual value. They can keep pretending that the amount they bought that debt for is still its value. Most of these losses are in two forms of debt: U.S. Treasuries and mortgage-backed securities. U.S. Treasuries are simple enough to understand. They are IOUs that the U.S. government gives to people who lend it money. If you hold a U.S. Treasury note with a face value of $100, it means the U.S. government owes you $100 that it has to pay by a certain time, and in the meantime, it has to pay you interest on that $100. Mortgage-backed securities are a little trickier. These are mortgages that banks have bundled together and sold on the open market to investors. When you take out a mortgage, typically the bank that lent you the money will take that mortgage, bundle it together with a whole bunch of other mortgages, and sell that to investors as a form of security. This gives the bank fresh cash with which to lend out more mortgages, and it gives the buyer of those mortgage-backed securities a stream of income from people paying off those mortgages. Normally, as a mortgage borrower, you don't even know this is happening because the bank that lent you the mortgage stays on as the administrator of the loan. You keep making payments to your local bank, but the local bank doesn't even own that mortgage anymore. U.S. Treasuries and mortgage-backed securities have one thing in common. Their resale value on the open market is largely determined by interest rates. Let's say you buy a Treasury bond for $100 with a 10-year term and a 1% interest rate. This means that every year you will collect $1 in interest and then get your $100 back at the end of 10 years. If you go out into the bond market and sell that bond, you can get something close to $110 for it, the total value of the bond plus interest paid on it. But what happens if interest rates go up, like they have over the past year? Let's say the interest rate on the 10-year bonds goes up to 4%. Now you can get a fresh new $100 Treasury bill that pays $4 per year. Over the course of 10 years, you get $40, and then your original $100 back. But what about all those treasuries paying out 1% interest? Nobody wants to buy those because the new bonds have way better rates. If you want to sell your T-bill with a 1% interest rate, you have to sell it at a discount that allows buyers to make $40 from it, just like the new bonds, which means you have to sell it for $70. And boom, your $100 Treasury bill is now worth only $70. The same is true with mortgage-backed securities, commonly known as MBS. Their value depends on mortgage rates. A little over 30 years ago, 30-year mortgages in the U.S. were available for under 3% interest. Today, it's over 6%. This means that all those MBS from a year ago or more are now worth a lot less on the bond market than the value of the mortgages themselves. And the thing is, banks today own a lot of U.S. Treasuries and a lot of MBS. Trillions of dollars worth. In normal times, they're a great source of steady income for the banks. But if people start pulling their money out of banks, those banks have to sell those treasuries and MBS to cover the withdrawals. And that's when the reality kicks in. Those things aren't worth what they used to be. That is what the $1.7 trillion of unrealized losses means. So, just how many banks are at risk from collapse due to those losses? According to another study, it's more than 1,700 banks in the U.S. alone. That's right, 1,700 banks. Now, you might have come across news reports a week or two ago about a study saying that around 200 U.S. banks could be in trouble. That study was reported on in lots of places, like The Week, The New York Post, and The Washington Times. But what those news reports didn't tell you is that this estimate of around 200 banks is actually the best-case scenario, and a very unlikely one at that. It was an act of journalistic malpractice. It wasn't a lie, but it was only a tiny sliver of the whole story. So let's take a look at what the study really said. The study comes from the Hoover Institute, a think tank that's over 100 years old and was set up by U.S. President and Stanford alumnus Herbert Hoover. This study looked at 4 different crisis scenarios of what could happen to these banks that have so many unrealized losses on their books. The first scenario looked at what would happen if the banks were forced to sell all their debt holdings at the current low market value. In that scenario, 2,315 banks would fail. That's more than half of the 5,225 working banks in the U.S. But that scenario is unlikely. The banks will likely never be forced to sell all their debt holdings because all bank deposits are insured by the FDIC up to $250,000. And that means with people with less than $250,000 in the bank don't need to worry about getting their money back. They likely wouldn't join a run on their banks because they have nothing to lose. So a more realistic scenario is what would happen if depositors with more than $250,000 in their bank accounts all tried to pull out their money at the same time. If that happened, the Hoover Institute study estimates that 1,619 banks would fail, a little under a third of all banks in the U.S. But even that may not be a very realistic scenario, because we know, based on what happened in the last few weeks, that when a bank fails, the government will step in to cover at least part of the uninsured deposits. On the other hand, Janet Yellen has said that with future bank runs, the government won't cover uninsured deposits. Maybe she's bluffing in order to keep banks behaving responsibly, but who knows for sure? So the authors of the study looked at another scenario where uninsured depositors withdraw half their money rather than all of it. In that scenario, only 186 banks would fail, if you can consider that to be only. But that's the number the news media reported. This best-case scenario is the only one they reported on. But here's the thing, this best-case scenario is also not a very realistic scenario, because it assumes that if those banks put their debt holding on sale, they would get current market prices for them. But when a bank tries to sell a huge amount of debt, it's essentially flooding the market with new supply, which reduces the price. They wouldn't get full market value. Based on Silicon Valley Bank's experience, banks would have to discount their sale price by around 0.4%. Now, that may seem like a small amount, but when you're talking about billions in holdings, it makes a huge difference. Enough of a difference that in this scenario, the total number of banks that would fail rises to 1,724. And that is the most likely scenario if there is a run on banks. Fully a third of the banks in the U.S. would collapse if the bank runs we saw in recent weeks continue. According to the Federal Reserve, more than $100 billion was pulled out of the U.S. banks in 1 week in mid-March. So, how do we stop it from happening? Well, so far the only idea on the table, which we saw during the SVB collapse, is the Federal Reserve starts printing money and gives it to the banks or to the FDIC to cover the losses. But here's the problem with that. Printing money is what the Fed and other central banks around the world have been doing for years. It's what they did during the great financial crisis of 2008, and then they printed even more money during the COVID-19 pandemic. All that money printing is the major cause of the inflation that we've been seeing over the past year or two. Now you might say, hold on, people are saying it's businesses taking larger and larger profits that's causing inflation, and others are saying it's rising wages or supply chain issues caused by the pandemic or the war in Ukraine. But that's just how inflation manifests itself, and it's not the cause. In the words of Milton Friedman, the economist whose ideas about inflation are considered the authoritative view on the subject, inflation is, quote, always and everywhere a monetary phenomenon. In simple words, what this means is that inflation can happen through businesses raising prices or through wage hikes, but it can't happen at all unless governments first print more money. After all, you can't spend money that doesn't exist, right? And so this is the problem with the bank bailouts we've seen in recent weeks. It means more money printed, which will mean more inflation. And the longer inflation sticks around, the longer central banks will have to keep interest rates high to fight that inflation. And the longer interest rates are high, the riskier things are for those banks holding low-interest debt. It also means more risk for everything that depends on interest rates, like the housing market. And as 2008 showed us, a housing market downturn can cause a recession. So there is no easy way out. One way or another, the banks, businesses, and consumers will end up paying the price for years of money printing and excessive borrowing. The longer rates stay high, the more things will break, as we've seen with this bank crisis. Where the next breakdown will be is anyone's guess. But one thing is for sure. We will be covering it all here at Debacle Economics. If you like this video, hit the like button so YouTube shares it with other viewers. And make sure you hit the subscribe button so you'll be notified instantly when our coverage of the unfolding financial crisis continues.